All right, let's get right into it because we've got a classic Wall Street mystery on our hands today. Expedia just dropped its Q4 earnings report, and on the surface, it looked like an absolute home run. But the market, well, the market had a very, very different idea. And this is the heart of the puzzle right here. On one side, you've got the company's own highlights. They beat their guidance, expanded margins, and had record free cash flow. I mean, that sounds fantastic, right? You think investors would be popping champagne. But instead, you look at what the stock did, and it took a nosedive, down over 6%. So what is going on? That brings us to the big question we're going to unpack in this explainer. What on earth did investors see hiding inside this report that just completely soured them on an otherwise great-looking quarter? Turns out the answer is buried in the details. To solve this, we've got to first appreciate just how good those headline numbers really were. I mean, when you just look at the big picture stuff, it really looked like Expedia was firing on all cylinders. First up, gross bookings. Now, you can just think of this as the total price tag for all the flights, hotels, and car rentals sold across all their websites. They hit a whopping $27 billion. That's a huge sign that people are definitely out there and eager to travel. And that spending translated directly into really solid revenue growth for the company, up 11% compared to last year. The top line was growing right in lockstep with all those bookings. So far, so good, right? But here's the number that should have blown the doors off. Adjusted earnings per share, which is just a key way to measure how profitable the company is. It's skyrocketed by 58%. Wow, I mean, a number like that usually sends a stock to the moon, but not this time. And that's where the plot really thickens. So how do we square this circle? Well, the biggest clue is realizing you're not actually looking at one single business. To really get what the market was thinking, you have to see Expedia as a tale of two very different businesses that just happen to live under the same roof. So first, you've got B2C, or business to consumer. These are all the brands we know and use, like Expedia.com, Hotels.com, and Vrbo. They sell directly to us, the travelers. But then you've got the B2B side, business to business. This is like the engine room of the company, powering travel for other big partners like airlines or financial institutions. And as you're about to see, their growth stories could not be more different. And boom, here it is. This is the first major clue that solves our puzzle. Just look at that difference. The consumer business, B2C, grew by just 5%. But the B2B side, it absolutely exploded, growing at 24%. That's not just a gap, that's a chasm. And this wasn't just a one-time thing. The trend for their big consumer brands has been kind of stuck in the low to mid-single digits for a little while now. It's stable, sure, but it's not exactly setting the world on fire. But then you look at the other side of the coin, and it's a totally different universe. The B2B business is on an absolute tear, consistently posting these huge 20+% growth numbers. This is clearly the new growth engine for the entire company. Okay, so you might be wondering, if the huge consumer side is slowing down, how in the world did they post that massive 58% profit jump we saw earlier? Well, it all comes down to a laser focus on efficiency, on squeezing more profit out of the business they already have. And you can see that focus paying off right here. Take a look at their adjusted EBITDA, another key profit number. Look at that jump, a 32% increase. This is pretty much hard proof that their strategy to get more efficient is absolutely working, and it's really boosting that bottom line, even while the business itself is changing. But, as any investor will tell you, the past is interesting, but the future is what you're really paying for. And this, right here, is where the market probably started to get a little nervous, the company's forecast for the year ahead. So looking at their guidance for the full year, they're expecting gross bookings and revenue to grow somewhere in the 6 to 9% range. Now, don't get me wrong, that is solid, healthy growth. But it's a slowdown from the 11% we just saw, and it's a far cry from the kind of explosive growth some on Wall Street might have been hoping for. Okay, so let's put all these pieces together and officially solve this earnings puzzle. Why did a great-looking quarter lead to a not-so-great day for the stock? So here's the bottom line. The market looked right past those fantastic headline profits. It saw the story we've just unpacked, this tale of two different businesses. You've got the massive consumer side, and it's slowing down, and then you've got this booming B2B engine. So when you combine that slowing consumer growth with a future forecast that's, good but not spectacular, some investors just decided it was time to sell. It wasn't really a bad quarter, it was just a complicated one. And that really leaves us with a big question going forward. The company has clearly built an incredibly powerful B2B machine that's driving the business now. But is that engine, plus their new focus on profitability, going to be enough to convince a pretty cautious market that Expedia's best days of growth are still ahead? That right there is a story to watch.